Okay, so let's start. Good evening, and let's start. So, I guess all of you, or most of you, are here. The others will kind of join, I hope, over the next few minutes. So the first thing is, I had so all of you have the assignment. I hope there is no confusion, anything on the assignment. Okay. So I think all of you are clear on the assignment, so we can start. We can get on with the rest of it. So what I'm going to do next today is, the next thing is, do you have any questions from the forward to the futures part that we finished yesterday? Okay. If you don't have any questions, we can move on. We can kind of go on to today's sessions. So the next bit is primarily going to be on options. And then right at that, I'm going to talk a little bit about swaps. But the next 3 days, at least today, tomorrow, and Wednesday, we'll be talking about options and how option markets work, how option pricing is done, and stuff like that. And then, as I said in the last day, maybe I'll talk a little bit about swaps. So the first thing is essentially the basic mechanics of the options market. Let's start with that. So this is just a recap of the notations that we keep on using across the whole stuff. Unfortunately, again, there's this obviously canvas since we playing up and plays up every day. So that where that thing is kind of coming up as a square blank box, which is volatility of the stock price. The normal notation is the sigma, is the Greek alphabet sigma. So what I have out here, as you can see, I have the euro. I mean, we've discussed in Europe what is an European call, an American call, and what is a call and a put, and all of that. So what we are talking about here is essentially, so notation. We will obviously at some point as we go forward find out the values of, have to calculate the values of C and P and all of it. But I'm saying that small c and small p are the values of the European options, European call and European put options. And if you look at the lower half of the table, lower half of this list, capital C and capital P are the prices of the corresponding American options. So small c is the price of the European call option, capital C is the price of the American call option, and similarly small p is the price of the European put option, capital P is the price of the American put option. Now, any option price is dependent on 5 terms. And what are these terms? The current spot price, which is given by S0. The current asset price or the current stock price, which is S0, which is today's price. The strike price, which is K or X, whatever you want to take it. The future value, the strike price, at the price at which you will settle the option. That is the second thing. What is the life of the option? T is the life of the option. And therefore, T is essentially T is one important aspect out there. Right? 2 more terms, and it's not in that order. The next term is the interest rate. So the last term out there, the interest rate applicable for this option. What is the interest rate applicable in the market that you can kind of use to to price this option? So the interest rate applicable is the 4th term, and the 5th term is volatility or sigma. These are the 5 terms that define the option price. Now, there are 2 more terms that I have defined out here. Let me talk about that, and then I want to talk a little more about these 5 terms. So, if S0 is the current price, the price on maturity is going to be ST, or S of capital T. So that is what the stock price is at option maturity. It is not the option price. Please remember that is not the option price. It is the stock under price of the underlying stock at maturity. Right? And in general, we will assume that there are no dividends that are paid during the life of the option. However, if there are dividends that are paid during the life of the option, then like we talked about for the case of the futures and forwards, here also we do the same thing. We take the present value of the dividends during the life of the option. So we kind of calculate the present value of the dividends, and so therefore we realize that this will be applicable only if the dividends are known, and therefore we can calculate the present value of the dividend. If the dividends are not known, then we cannot do anything with this. Right? Now let's go back to the first 5 terms that we're talking about: the current spot price, the strike price, the interest rate, the time to maturity, and volatility. Now, of the 5 terms, the spot price and the interest rate are something which are available in the market, and you don't have a choice on it. Those are chosen in the market, so you actually have to go with the market data. You actually go with the market rate, and therefore that is kind of nothing but the market value. Strike and time to maturity are your choices. So you can decide. Obviously, the price is going to be dependent on the value of the option, on the strike price that you put in, on the life of the option. That's there. But you can decide what these values are going to be. You can decide what is going to be the strike price. You can decide what the time to maturity is going to be. And these are not. There is no ambiguity in this process. What I mean by that is there is only one. I mean, if you say the strike price is going to be $50, all of us have only one understanding of what $50 is. It cannot be said that what is $50 to you is $20 to me, and $30 to somebody else, and $100 to a fourth person. It is the meaning of $50 is the same to all of us, and that is the advantage that this kind of has. Similarly, time to maturity. If you say the option is a 1-year option starting today, we all know what. If you start today, we all have the same understanding of where the 1 year is going to be. So therefore, this can be defined or designed by you. But once it is designed by you, there is no difference in opinion in terms of what that value is, and that is important in this whole scheme of things. So you have the same value that you understand and all of that, right? Now, one other small thing in time to maturity, there are 2 ways in which you can write it. You can say it is a 1-year option starting today, and therefore you know that if it starts today, 1 year from today, so the expiry will be on January 16, 2023. Right? So that is how the 365 days will come about. You don't have you automatically know what the expiry date of the option is going to be. The alternate way is to say, okay, today is the start date, and the expiry date is, so the start date is 17 January 2022. The expiry date is 16 January 2023, and hence, using that logic, we know it's a 1-year option. Both you can report it in either way. You can either report it, as I said, in terms of saying what is the effective duration of the option. So you say it is 1-year option, 2-year options, or whatever, or you say that it is starting. You give the start date and the end date, and therefore you can find out what the life of the option is going to be. Right. So that's the position that's the thing that we kind of have in that scenario, right? But those are easy because those are kind of determined by you. There is really no challenge in that determination. There is effectively everybody has the same meaning of that. On the other hand, sigma is a problem because sigma is nothing but as we defined, is the volatility of the underlying stock price or underlying asset price, not just stock, whatever is the asset. So in this case, we are taking stock, but whatever is the underlying asset, it is the volatility of the underlying asset price, which is fine. But the problem is here. How do we calculate volatility? Well, we calculate volatility by calculating the standard deviation of the underlying returns, the returns of the underlying asset, which is good. So we calculate the standard deviation of the returns. To calculate the standard deviation of the returns, what do we need? We need the values of the returns, and what is a return? RI is nothing but the change in the spot price. Let's say the daily change in the spot price. So SI minus 1 is your return. So effectively, to calculate the volatility of the stock price, which is nothing but the standard deviation of the return, I need the essential stock prices so that I can then calculate the return, and having calculated the return, I can then calculate the volatility of it, right? The variability of it, which is good. But here again essentially, so to that extent, the approach is easy because as long as we know the stock prices, spot prices, calculate the we know how to calculate the what do you say the the volatility, the standard deviation, and therefore we can calculate it. But two problems. One, the first problem is we are trying to now we need the spot prices. We are standing at time point 0. We are trying to calculate volatility for the future. However, do we have the future spot prices? And the answer is no, we do not have the future spot prices, which means that I will actually have to calculate based on historical data. I will have to calculate based on historical data. Right. Now the question is, how good will the historical data be appropriate for the future? How good will this historical data be good enough for the future? And that is a huge question. That is a huge question. How good is the historical data for the future? And that is the biggest challenge in this whole thing. Because the historical data may not be good enough for the future. In the sense, the historical data may not represent the future value well enough, and then you can actually end up having a problem. The other issue is, okay, now I'll look at historical data. If I take the historical data and if I want to calculate standard deviation, remember what is the standard deviation formula? The standard deviation formula is you take the mean, you subtract the mean from the observation, square it, sum it up, and then take the average of that and then square root of that. Now the question is, what is how far back do I go to calculate the volatility or the standard deviation? Because remember, the standard deviation formula has a 1 by n summation I equal to 1 to n xi minus x bar whole square. This is fine. But what is the n? How many n? How far back do I go? Do I go back by 1 day, by 5 days, by 10 days, by 1 month, by 6 months, 1 year, 5 years? How long? And I don't know how long I need to go. Because there is no correct answer to saying that you need to take 6 months data, you need to take 1 year data. I have no one number to say this is the amount of data that I need to take. It could be, I mean, and somebody might say I'll take 1 month data, somebody else might say I'll take 1 year data, and I do not know which is, I mean, none of them are correct, none of them are correct, none of them are incorrect. So that becomes the challenge in this whole process, right? So that is one of the questions that kind of come in, which make it different, and that is why this is the only term that will show up as different. All the other terms are the same. So the only term that will show up as being different in the scheme of things, in all of this, is essentially the estimate of sigma. Now, it is not that we know the true estimate of sigma. That is why we cannot find out what the true estimate of sigma is going to be. We don't know how to calculate that. What is the exact value? What is the exact model to kind of calculate that? So we cannot say that one is correct, the other is incorrect. And that is the fundamental problem that we kind of land up with this model. But and therefore we cannot say that one is, as I said, we cannot. I am repeating in a sense that this is correct and that is not correct. So that is the problem that we kind of land up having. But with what choice of sigma to take essentially causes the difference, because if you take different sigmas, you will have different estimates, and hence your estimate of the volatility, which then goes into solving the equation, which then, as you will see later, which then goes into calculation of the price of the option, is different, which causes which is what causes the prices to be inherently different. Because all the other terms you realize is the same. So the only term that can be different is essentially these numbers, and these numbers are changing because of these factors. These numbers are changing, these numbers are different because of these factors, and hence you actually end up having a problem in that sense. And I do not know what the correct answer is, or I do not have a convergence on the same value, and hence that kind of makes it different. So one has to keep that in mind to understand that that is what is the problem that will kind of show up. Now, just quickly to revise what we did earlier. So a call option is an option to buy. A put option is an option to sell. A European option, and this we've done earlier, an European option can be exercised only at the end of its life. An American option can be exercised at any time up to expiration date. We have defined all of this earlier. This slide is just to kind of review or recap what we have already talked about earlier. Also, what are the kind of options, the types of options that you can have? You can have exchange like forwards and futures. There it was very clear. If it's a full futures contract, it is exchange traded. If it is a forward contract, it is OTC. Here, the assets, you can similarly have exchange traded and OTC options. So exchange traded options are the ones which trade using stocks, foreign currencies, stock indices, futures, and all of that. On the other hand, OTC options are typically non-standard options. These are what are called as OTC options. These are also what are referred to as exotic options, and these are essentially non-standard options. So just to give you an idea of what a non-standard option can be, and to kind of show you highlight one of them, which is a Bermudan option. We'll talk about Asian option later. At this point, just to give you an idea. So if you think of it, think of an American option. An American option can be exercised on every single day of the option life. So on every day, you can potentially think of exercising it. Obviously, you can exercise it only once, but you have a choice of exercise on every single day. Now, if I said that instead of exercising every single day, you will have the right to exercise it, let's say, only on Mondays and Wednesdays. So let's say it's a 1-year option, and I tell you that you can exercise it only only on a Monday or a Wednesday. You cannot exercise it on a Tuesday, Thursday, Friday. Which means what? You do have multiple exercise choices, but not all exercise choices. So you can exercise it. You do have some choice, but not all choices. This restricted set of choice is what is referred to, or if you have an option where you have multiple choices, but not all choices, a restricted set of choices, that is what translates to what is called as the Bermudan option. So the Bermudan option is a scenario where you have the ability to translate it, to kind of have a few choices, not all choices. So you can exercise it in a few cases, not in all cases, and that is what is essentially referred to as a Bermudan option. Now, one of the largest trading things is the National Stock Exchange of India, and what again I've done out here is I've given you the links to see that what as the term sheet would appear in an option framework, in a market, in an exchange. How would it kind of look like? If you want to go in and have a look at it, this will only help. This is not really very important. This allows you to kind of have a look at the kind of schemes that kind of structure and kind of information that an exchange puts out in terms of its option specifications and strike prices and all of that. Right? Now, again, something I defined on the first day, there is something called the moneyness of the option. And what is the moneyness of the option? Option is defined to be in the money if that would lead to a positive cash flow if it is exercised immediately. So if the option were to be exercised right now, would it lead to a positive cash flow for the holder? If that happens, then the option is said to be in the money. Obviously, if the option if by immediate exercise it does not lead to any cash flow, so it is exactly, cash flow is exactly zero. It is essentially referred to being at the money. And if an exercise, immediate exercise leads to a negative cash flow, it is kind of referred to as out of the money. So an in the money option implies that immediate exercise will lead to a positive cash flow. An out of the money option implies that it will lead to a negative cash flow. At the money means it is going to be equal to zero. So now if ST is the price on the day you're exercising it, X is the strike price. So for a call option, for the option to be in the money, ST has to be greater than X. For it to be at the money, ST has to be equal to X. And for it to be out of the money, ST has to be less than X. For a put option, the exact opposite will happen. For me to be exercised, for a put option, ST has to be less than X for it to be immediately exercised and then money to be made, and that is when it will be in the money. If ST is equal to X or ST is equal to the strike price, then the option is at the money, and if ST is greater than X, it is out of the money. So you can see that while at the money levels are the same for both the call and the put, for the in the money and the out of the money, just interchange between the call and the put. So an in the money call option will, keeping everything else the same, will essentially translate into an out of the money put option for them. That's what in the money and out of the money definitions are. So this is exactly what I said, and I've also written down in this whole fashion. Now, given that you have an option holder has a choice of exercising the amount, exercising the thing, therefore realize that an option will only be exercised if it is in the money. An option will never be exercised if it is out of the money. It does not make any sense to exercise an option that is out of the money. You will only exercise the option if it is in the money. K is the strike price, as I have written up there. S is the stock price, and therefore I have given you the exact framework where the option is in the money, out of the money, and at the money. And as I said, and as I'm repeating, as you can see, the at the money level is the same on both sides. The in the money is kind of in the money and out of the money are exactly opposite to each other. Okay. Now there is something called the intrinsic value, time value, and total value of the option. Now and as I said out here, the intrinsic value of the option is defined as the maximum of zero and the value that you would get if it were to be exercised immediately. So essentially, the intrinsic value is nothing but the benefit that you get, the maximum of the benefit that you get by immediate exercise, and zero. So therefore, for a call option, the intrinsic value is therefore maximum of S minus K and zero. Remember, for a call option, you will be able to buy it at K when the market price is more than K, and therefore your benefit is S minus K. If you do not exercise, if this is less than K, then you do not exercise it. So essentially, it's a maximum of S minus K and zero. On the other hand, by the same logic, for the put option, the intrinsic value is maximum of K minus S and zero, because you can exercise it. You will exercise it when the asset price is less than the strike price. So the benefit that you will make is K minus S. If the asset price goes above the strike price, you will not exercise it because it's more profitable for you to sell it in the market and make a larger profit. So an in the money American option, but must therefore be at least intrinsic value, must be at least its intrinsic value, since the holder can realize the value by exercising immediately. Now, often it is not. So basically, for an American option, it has to be in that sense. Now, often it is not optimal for the option holder of an in the money American option to wait rather than exercise immediately. Then if that happens, the option is then said to have the time value. And what is that? The total total value of the option is the sum of the intrinsic value and its time value. Another way of thinking about the time value is to say, look, particularly in American option, in an European option, it doesn't matter because you don't have the choice of exercising early. So this is only hypothetical. You can't really find out a point at which you can exercise. However, for an American option, you can. And the American, I mean, the other way of looking at the time value in the context of an American option could be that you can defer your exercise date. Right? Okay. So the American option is the only case that you can exercise it early, and therefore, in effect, the intrinsic value story only applies to the American option. Now, in an American option, let's say you have a 90-day American option, which means you can defer your decision from today to tomorrow to day after to exercise, and you can potentially defer it for 90 days. So now as you defer it, there is a change in the price. So the amount of price change that happens due to your deferral of the decision is what is also referred to as the time value of the option. So you're basically not exercising it the earliest point. You're exercising not exercising the last point. Right? So you can only exercise an American option early. So if you exercise the American option early, you can if you can then calculate what the time by deferring your exercise, the change in the price is essentially arising out of the time value. And at any point, the sum of the time value and the intrinsic value is the total value of the option. So the other way of looking at it is, if I can value the total value of the option, I can find out the intrinsic value, which is straightforward. The difference of the two is what is referred to as the time value of the option. So that is how I can also calculate the time value of the option. Now, remember we talked about margins yesterday and earlier as well. So in the context of futures and forwards, both the buyer and the seller of the contract, so the person who goes long and the person who goes short, needs to have margin accounts, needs to keep margin accounts. In the context of options, it is only the person who sells the option, who writes the option, who has to kind of keep margins. This is because the person who has gone long, who has bought, whether it is a call or the put, does not matter. The moment you bought, you do not need to submit any margin any longer because they have no incentive to default. Why? Because think of it, let's take a call option. If the price goes above, even if they don't need it, they will always exercise it because they can buy the option at a cheaper price. So therefore, they don't have the incentive to default on that side. If the price goes below the strike price, well, they are entitled not to exercise it there because they have paid the premium, they are losing the premium, and therefore they are entitled not to exercise it. In which case, the argument of default does not arise in their case. Same is the argument with the put option. So there is no question of a default that can happen, and hence traders with a long position in the option market do not need to keep any margins. It is only traders with a short position or a sold position in the option market who need to keep margins, not the others. Right? Also, if you do this kind of thing, if you write a covered call, so this is kind of a specific product. A covered call consists of writing call options when the shares that might have to be delivered are already owned. So you already have the shares that and then you write the options on that. So in case the option is exercised, those shares will have to be delivered, which you already have. Now, these are obviously far less risky than what is called as naked call options, which is, naked call option, you don't have any protection. In this case, you actually have a protection because the worst that can happen is the investors would be required to sell their shares at a price, sell the shares that they already own at below their market value. But it is not that they need to go and acquire it at the current market value and sell it at a price lower than the market value. They already have it, and it's just kind of handing over or transferring that in that sense. So therefore, obviously, if that happens, their maximum loss is covered. So they don't, in this case, they don't need to keep a margin and they don't need to keep margins. So effectively, if you can cover your losses, if you can take a protection, then you do not need to, then there is no need for you to kind of keep a margin. You need to keep a margin if you cannot, if the risk is still open, and therefore you would need to kind of account for that potential loss that can happen in case you default. So, and obviously, only the writer can default. If the writer defaults, that is when the protection would need to come in. So if you're a writer, in this case, even if you default, well, you have the asset, so there is no question of default that will happen. Well, there is a question of a default that can happen, which is if you willfully or deliberately default. Now, the assumption in all of this is that there will be no willful or deliberate default. Default will happen because of market factors, because you do not have the ability to kind of deliver it in the market. Now, just to kind of give you a quick example or an explanation, so this is the margins that you will have to pay, the margins that are payable on the Chicago Board of Options Exchange. For a naked call option, which is I just write the option and I do not take any protection, it is the greater of 100% of the option plus 20% of the underlying share price less the amount, if any, by which the option is out of the money. And total of 100% option proceeds plus 10% of the underlying share price. So they basically said that, okay, you can take 100% plus 20% of the underlying share price. But if the share price, if the option is out of the money, then that amount, the amount by which it is out of the money can be reduced from here. Or you take 100% of the option proceeds, 100% of the benefit of the option at any point, plus 10% of the underlying share price. Now, strictly speaking, 100% of the option proceeds is good enough. I do not really need the 10% of the underlying share price. But that is kept because there is always going to be a lag between managing the margin account portfolio and the actual market portfolio. So therefore, this will kind of also protect, right? Similarly, for the put option, this is less, instead of greater, it is less. It is greater of the same. I mean, in a sense, it's the same way. Total of 100% of the option plus 20% of the underlying share price less the amount, if any, by which the option is out of the money. And similarly, a total of 100% of the option proceeds plus 10% of the exercise price. Here it is the exercise. The only difference is if you compare the two, second choice in the case of a call option and the second choice in the case of a put option. In the case of a call option, it is 10% of the underlying share price apart from everything else. In the put option, it is 10% of the strike price, obviously apart from everything else. So that is a small difference that shows up in the two scenarios. Again, we've done this. I don't want to go back here. This is the if anybody is interested to look at an example, you can go and then there is an exact example that is computed out there, which shows how the margins are computed. One of the last things that I wanted to show you out here in the very initial bit before we move into some of the properties is that something called the put call ratio. So this is the ratio of the open trading volume or open interest of put options to call options. So you can either take the trading volume or the open interest, but you cannot, in one side you cannot take trading volume, and the other side you take open interest, and vice versa. You can take any one, but you can go with any one of them, and that of the put options and the call options in the market. The put call ratio is typically viewed as an indicator of the market sentiment. So what is the market view, the market sentiment, or investor sentiment in the market? So for example, if your put call ratio is 0.74, this means for every 100 calls bought, only 74 puts were bought. It's the contrary indicator, but this part is kind of a little confusing. So please listen to this carefully. This is essentially a contrary indicator. So this is not. So a reading of one or more is very bullish, as most people think that the market is going down. Because when will the reading be one or more? When the numerator is more than the denominator. So people are buying more puts than calls. That is when the ratio is more than one. when the majority thinks the market is going to move in a certain direction, it usually does the opposite. Because if everybody thinks it's going in this direction, everybody is kind of selling the stocks, everybody is kind of going low. Right? So therefore, this is contrary indicator. So basically, if you say the market will exactly do the opposite, so if you take a reading of one or more than one, which means what? You have more puts than calls. When will people in the market buy more puts? When they expect the market to go down as opposed to the market to go up. If the market goes up, the number of calls bought will be higher, which means the denominator will be higher, and hence it cannot be equal to one or greater than one. It's only when the denominator remains constant, the denominator goes down relative to the numerator, or the numerator goes up. That is when you can have the ratio to be greater than one, or close to one, or greater than one. And as I said, it is kind of it is some sort of a contrary indicator, because it is not exactly that the call put ratio goes up. It means exactly the same manner. It means exactly in the opposite manner in terms of the market movement. So that's what this argument kind of does. Okay, let's look at a few examples before we move on to the next set. Market value of $47.5. Put is available on the stock with a strike price of $55 and is selling for an option premium of $10. So, which of this is the correct statement? So, without looking at the answers on the next slide, any one of you, would you want to attempt it and put it out on the chat box? Which of this is the correct statement? Given what we did earlier in terms of in the money and out of the money, which of this is the correct statement? Which of this is the correct answer? A, B, C, or D? Which of this is the correct answer? Nobody? Well, it's straightforward. It's A, right? Absolutely. You're correct. You're correct, Hugh. It's correct. It's A. Because what is it? The current price is 47. The strike price is 55. It's a put option. So therefore, if you exercise it today, how much will you get? You will be able to sell it. You will get it and you will sell it at 55 when the market price is 47.5, which means you'll make a profit of 7.5. So it's in the money by 7.5. The important thing to remember out here is option premium does not matter in the context of in the moneyness or out of the moneyness. In the context of in the moneyness or out of the moneyness, it is only the amount by which it is higher or lower that matters. The option premium does not matter in the scheme of things. Right? And this is the explanation for the same that I have. So here is a case where you buy a put on a share for $3. The starting stock price is 42 and the strike price is 40. Under what circumstances will the trader make a profit? There is a small difference out here, and this is something that matters. I am not saying that he'll get a positive payoff. I am saying where will he make a profit? So to make a profit, he has to also, so it's a put option. So currently the stock price is 42, the strike price is 40. So obviously if he exercises, he is not going to exercise it now. he will exercise it if the stock price goes below 40, right? But he has paid a premium of $3. So he will make a profit only if the price goes below 40 by $3. So if the price is 37 or lower. If the price goes below $37 or lower, then you have a profit. Otherwise, you don't have a profit, right? In between 37 and 40, he will exercise the option because that is a reduced loss, but that is not a profit argument, right? And if I were to draw the diagram, how would the diagram look like? On the next slide. So as I said, if the profit, if it goes below 37, the option will be exercised if the price is below 40. So the diagram is essentially this, right? Currently it is 42. So if it goes below 40, currently it's 42. Strike price is 40. So as long as the price is above 40, he will not exercise it and he will lose his $3 of premium. If it goes below 40, he will exercise it, realize at 37, there is a break even. If it goes below 37, he starts making a profit. If it is between 37 and 40, he will still exercise it simply because he will make a reduced profit. Okay. What about this one? What about this one? Somebody? Under what circumstances does the trader make a profit? So when does the trader make a profit? S is greater than 51. No. You're saying S is less than 51. It's a call option. Please realize. It's not a put option. It's a call option. So when does the trader make a profit? When does the trader make a profit? Not less than. How can it be less than? It's the other way around, right? It is not a. So 54 is correct because strike price is 50 plus 454. So he makes a profit when the price is greater than 454, not when it is less than 54. It has to be greater than 54. And why? And if you draw the graph, this is how the graph will look like. If the stock price is below 50, so sorry, he's 1 minute. You seem to be right. I mean, oh, he sold a call. Sorry, I'm extremely sorry. He sold a call. What I was thinking is he's bought a call. He's gone lost. She shot the call. So obviously, you are absolutely right. It is less than 54. So obviously, as long as the price remains below 54, he makes a profit. The option will be exercised at the moment the price is above 50. So if you look at it, this is how it will look like. It's a sold option. So at 54. So the point at which it is intersecting is 54. 55 is on this side. Is the next price. So at 54, it's break even. So as long as the price is less than 54, he will make a profit. You're right. My mistake. I was assuming it to be a buy side. Assuming, obviously with the sell side, he will make a profit if it is below 54. Right? Okay. What about this? European put option to sell a share for 60 costs $8 and is held until maturity. When will the seller of the option make a profit? When will the seller of the option make a profit? In this case, when will the seller of the option make a profit? So when does the seller of the option make a profit? In this case, when do you think the seller of the option would make a profit? Profits arise when stock price is greater than 68. It's a put option. No. The seller of the option, when does he make a profit? Remember the seller. When does the seller make a profit? What about the others? Somebody else? Yes, you're right, Hugh. It is the seller makes a profit when the spot is above 52. Because realize the option will be exercised at 60, but the seller has earned $8 because of the by selling the option he's already earned $8. So as long as the price goes to 52, even though he's making a payment of 60 minus 52, that is 8, his break even happens at 52. So therefore he makes a profit only if exactly the seller has already got 8. You're absolutely right. The seller has already got 8, and therefore the break even happens at 52 and not at 60. If we ignore time value of money, the seller will maturity option is greater than 52. This is because as you can see, the cost to the seller of the option is in these circumstances less the price received for the option. The option will be exercised if the stock price at maturity is less than $60, and if the stock price is between 52 and 60, there will be a profit, but it will be a limited profit. And if you therefore draw the diagram, this is how it happens. If the price is below 52, at 52, it is a break even. So as the price goes above 52, you start making a profit, because between 52 and 60, the option might still be exercised, but you will because the option holder will make a reduced loss. So if the option holder makes a reduced loss, you make a reduced profit. Once it hits 60, the option will no longer be exercised, and you make a constant profit of $8. What about this one? This is probably the last one. A trader buys a call option with a strike price of 45 and a put option with a strike price of 40. Both these options have the same maturity. The call costs $3 and the put costs $4. So where will the trader make a profit? Under what conditions of the asset price will the trader make a profit? So he has both a call and a put. He has paid, the costs are $3 and $4 respectively. The strike prices are there. So where does the spot price have to be for the trader to make a profit? So where does the trader have to be for him to make a profit? And in other words, as I'm asking the simple question, for what values of the option, what values of the underlying spot will the trader make a profit? This is a buy. This is a buyer. A trader is buying. So under what should be the prices? That means the trader makes a profit. Come on, there are a lot of other guys. Please do attempt it, because this is the only way. I mean, that the whole idea of trying to put in these small problems is to try to see if you guys have followed it, if you guys have understood it. Obviously, in the exam, I will not only give these kinds of problems, but I'll give a little more complicated problems also. So at this point, this is the only way for me to know whether you have understood what we have kind of done. I'm not in the class that I can kind of look at you and figure out whether you are, because none of you have your videos on. So I can't figure out whether you have understood the logic and understood what we were talking about in the earlier part of the class. Somebody attempt it. What will happen? It will just be, I mean, at best you'll get it wrong, but try it. You already have the solution on the next page. So, please don't look at the solution, because I would, if you don't understand it, please don't look at the solution, but please try it. For the call, no, no. Call option, you're right. Tran, you're right. For call option, profit is when S is greater than 48. What about the put option? You see, you have to add the premium. Strike price plus premium is when you get the profit for the call option. So it is not 45 minus 3, it's 45 plus 3. That's how the 48 comes in. What happens in the for the put option? What is for the put option case? Put option profit, you're absolutely correct, is when this profit is below 36. So now if I combine the two together, you're right, when profit is when not why 33 and 52. Where did you get the 33 and 52 from? It is 36 and 48, because 45 is the strike price for the call option. And the moment the price goes above 45 plus 348, he makes a profit. Similarly, 40 is the strike price for the put option, and he pays a premium of 4, which means as long as the price goes below 36, he makes a profit. So therefore, in the approach, you will make a profit if the price is below 36 or above 48. Between 36 to 48, you will not make a profit. For a part of it, he will make a reduced profit. He'll make a reduced loss, and for the rest of it, the other part, he will make a fixed loss. But if it is below 36 or above 48, he makes a profit. And this is how the graph will look like. Sorry, I don't know why this has happened. The table has got mixed up, but this is exactly what has happened. Asset price is less than 40. The payoff from the call option is 0. Put payoff is Oh, no, 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 no. You are right. I mean, sorry, you are right. You are right. I was doing it on one side, but the two, you are, you are right. It is 33 and 52. My mistake. Because he's paid both the premiums. I'm sorry. He's paid both the premiums. So he's the net. So while if I just take the call and the put, 48 and 50, 36 and 48 are correct. But since he's paid the other premium, the total premium he has paid is 7. Remember, he has paid a premium of 7, which is 4 on this side and 3 on the other, 4 for the put and 3 for the call. So net premium paid is $7. So his benefit, his option cost is 7. So the total profit is 33 minus 7. Between 40 and 45, it's minus 7, and above 45, it is going to be, it's going to be 50, ST minus 52. Which means that this is how the diagram will look like. Sorry, you were right. That's my mistake. It's my mistake. So look at this. The put option is the red line below 40, and it breaks even at 33, breaks even at 36. Two costs, breaks even at 36. But the call again is breaks even at the green line. It breaks even at 45, at 48. But what happens is that the net position is the black line. The net position is the black line, which breaks even at 33 on this side and 52 on the other side. So what you get is the black line. Now this, interestingly, this kind of a diagram is what is referred to as a strangle. So you can read it out here, and this is something which will show up in one slide after this. It is called a strangle. And then when would you do such a contract? So interestingly, when would you do such a contract? You see, you do this contract when you do not know which way the spot price is going. You do not, the current spot price is what you know is somewhere in between, but you do not know which way the spot price is going. The spot price may go below 33, may go above 40, above 52. So you want to protect yourself against both sides. Yes, the black line, yes, the black line covers all put and call costs. So the effective model, since he's bought both, the effective correct line will be the black line. The other two lines are only for the individual options that I show separately. But since you've combined the two together, your black line is the final answer, is the correct answer. And this is what is called as a strangle. And when you do the strangle, when you assume that you do not know which way the asset price will go. You know the asset price can move up or move down, but you are not certain which way it will go. You know, you do not, and you want to protect yourself against both sides movement. So if it moves up, you want the call option to cover yourself so that you can buy more assets at a cheaper price. If it moves down, you want to sell whatever assets you have at a higher price, and therefore you kind of have the put option to help you do that. Right? Okay. So this is the basic structure of the the mechanics of option market. Let us now move into the next set, which is called the properties of the stock options. So we're going to kind of look at the properties of these options at this point, and then some point we will move into valuation as well. Again, this slide is no different from the first slide that I used to start off. This slide is exactly just a recap of the notations that we had. So there is really nothing new in here. We are just taking the recap. I'm just writing down the notations once again for you to kind of be aware and then follow that. As I said, there are 5. Okay, you can keep the 6th one as the factors that affect option price. And because the reason why we're talking about this is we will talk about how these things affect. So as I said, you have the spot, the current spot, you have the strike, you have the time to maturity, you have the volatility. There should be a sigma which is not showing up appropriately, and then you have R, the risk-free rate of interest, and D, which is the present value of dividends during the life of the option. Now, D will not matter if there are no dividends that are being paid. If there is no dividend that is being paid, then that does not matter at all. because then the value of t is going to be 0. So the future dividend is going to be 0. Present value of the dividend is also going to be 0. However, if there is a dividend that is paid, then that matters and that has to be accounted for. Okay, what does this table show you? What does this table show you? What this table shows you is small c and small p are the European call and put prices. Capital C and capital P are the American call and put prices. If you change the spot price, so there are these 5 terms. If you keep the others constant, if you change any one of them, if you change the spot price, as the spot price increases, the call option moves in the same direction. The call price increases and the put price decreases. So if it's a positive sign, it means that the direction of move of the option price and the direction of move of the underlying factor is the same. If it is negative, which means it's opposite. So as you can see, as the spot price increases, so this table, if I look at the first row, it says as the spot price increases, the call price increases, the put price decreases. Right? In terms of the strike price, it's exactly the opposite. As the strike price increases, the call price decreases, the put price increases. So that is what this is kind of telling you. I'll explain what those two question marks are in a minute, but let's look at the other one. So now here, I don't know why here the sigma shows up appropriately. So if you take the sigma, now the sigma is interesting because if sigma increases, both the call and the put price increases. The call and the put prices both increase if sigma increases. So with R, it is exactly as the spot price, and I'll explain why this happens both theoretically and later with numbers. As R increases, the call price increases, the put price decreases. And what you can see is that when the call price increases, both the European call and the American call increases. When it decreases, both of them decrease. Right? So there is so the American call and the American options and the European options move in the same direction for the same set. So the American call and the European call move up at the same, but the amount by which it moves up and the amount to which it moves up both do not need to be the same. So because the original prices are different, American option prices are always more than the European option prices. So obviously the American option price, let's say the European option price was $10, the American option price was $15. When it moves up, the European option price from 10 may move to 12, but the American option price from 15 may move to 20, or vice versa. The European call can move from 10 to 15, whereas the American call may move only from 15 to 16. I do not know, I cannot comment about the amount of move that each of these options will have. But I am certain, and what we can show is that the direction of move will be the same. So if the interest rate increases, the call prices increase, the put prices decrease. What is this question that you have? Variables affect on call put price? Euro US? No, it doesn't matter. It's not just Euro US or whatever you take. It is essentially, so if you buy an option, so the question is if you buy an option, right, and then the asset price increases, what will happen? So for example, if I would, so I know it is not there, but let's say there was an option available on, let's say my favorite stock, Vietnam Airlines. Now, keeping everything else constant, the price of Vietnam Airlines stock in the market has gone up. What will happen to the call price? What will happen to the put price? That's the first slide. The call price will go up, the put price will go down. I'm not in whichever currency the price is written, it will be the same, whether it's written in euro, in US, in GBP, in VND, in JPY, it doesn't matter. It will still be the same. If the euro, if it's a euro US, then as the euro, if it's the exchange rate between the euro and the US dollar, well, as the dollar moves up, as the exchange rate moves up, depending on how you've written the exchange rate, the corresponding and the call option will move in the same direction. So essentially, this is a movement of the underlying in the same direction as the if it is a plus sign, it's in the same direction. If it's a negative sign, it's in the opposite direction. Okay. Okay, let me explain this, how this happens, and then the graphs also. There are graphs that kind of show up. Okay. So let's take the first case. Option price versus stock price and strike price. So now the option is exercised at some point in time in the future. What will be the payoff from the call option? The payoff from the call option will be the amount by which the asset price exceeds the strike price. The payoff from the call option will be the amount by which the stock price exceeds the strike price. So as the stock price increases, not the strike price, please realize as the stock price increases, this amount will be higher for the call option, and therefore and less valuable as the strike price increases. So when the call option, when the stock price increases, keeping the strike price constant, this difference becomes larger. When the spot price remains constant, but the strike price increases, this difference narrows. So therefore, when the difference increases, the price increases. When the difference narrows, the price decreases. So therefore, as the spot price increases, the call option becomes more expensive, the put option becomes less expensive. As the strike price increases, the call option reduces in value, the put option increases in value. And if you want to draw this is what will happen. So if you look at it so I've taken my strike price to be 50, S naught and K to be 50, R is 5, T is 1, and there is so as the option, so below a certain level, the price is 0. Now, below the call option value will always will kind of go to 0. Beyond that, at some point, with the adjustment for the premium, the price starts getting a benefit, and as the price increases, as the stock price increases, you see the call option value also starts increasing. Similarly, when the put option, as the strike price falls, the put option value keeps on increasing. As it comes closer to maturity, it will essentially go to, so as it goes above the strike price, it goes to 0. And this is the same example with the strike price, but just going the other way around, because the stock and the strike work in opposite directions. Now, this is a slide. Okay, this I should actually have first talked about out here before I jumped it. I forgot to say that. So if you look at this slide in the time to expiration P, I have kept, for the European options, I have kept it as question marks. I have not written anything. The reason why I have not written anything is simple. Now, strictly speaking, in an European option, we cannot increase time because we don't have the choice of exercising later. There is only one day on which you can exercise, which is the final maturity date. Whereas in the context of an American option, you can defer the decision. And therefore, in a question of increasing time or delaying the decision can happen with respect to the American option, strictly speaking, not with respect to the European option. That's why what I've said out there. Second, but I'll tell you why that plus. But the second thing that you see is that as the option price increases, both the put and the call option become more valuable. So think of it this way. Let's say the current asset price is 100. The call option, the strike price is 150. If the option is to be exercised, then you need to cross, the asset price needs to increase by at least 50 in 3 months. Remember, time to maturity is 3 months. Current price is 100. Strike price is 150. So therefore, for the option to be exercised, in the next 3 months, the option price has to rise by at least 50. Which means that on an average, this does not have to be exact, but on an average, in a month, the price should rise by 50 by 3, which is 16.67. So on an average, if it was linear, in a given month, it should rise by 16.67. Right? Now, if I kept everything to be the same, and I said, okay, instead of 3 months, I gave it 6 months, right? So then that would be 50, that is everything else is the same. So the amount of time it would take, the monthly move, the average monthly move should be expected to be 50 by 6. Now, which is higher, 50 by 3 or 50 by 6? So that is what is happening. So if you take it to 50 by 3, now the question is 50 by 3 is more higher than 50 by 6. So what happens is the likelihood of the stock price crossing 50 by 3 is what? Is 16.67. Whereas 50 by 3 is, sorry, 50 by 3 is 16.67. Whereas 50 by 6 is 8.33. Now the stock price has a larger probability of crossing 8.33 as opposed to 16.67. And therefore the price of the option becomes higher. So the increase in the likelihood of the exercise increases the price. Now that is exactly what I have explained out here. So what happens as the owner of as the American call increases, sorry, as the owner of the long life option has the ability to exercise at any point in time. So you can actually the long life option was there. So longer the life, the number of exercise possibilities increase, and therefore the cost must be at least as much as the short life one. In general, it will actually be more expensive. Now, European put and call options do not necessarily become more valuable as the time to option expiration increases. Because irrespective of what happens, you can only exercise on one day, which is the maturity of the option. So, but what can this happen? There's a problem with this. Let's say you have an option on one stock with expiration date in 1 month and another with after 2 months. A very large dividend is expected in 6 weeks. So I have one option which expires in 4 weeks, another option that expires in 8 weeks, and I have a very large dividend that is coming in 6 weeks. The dividend will cause the stock price to decline. And this can potentially imply that the 4 week option is more expensive than the 8 week option because the dividend is being paid after 6 weeks. So the first option does not get impacted, but for the second option, it gets impacted. And therefore, it could actually be that the price drops significantly, which causes the option to be worth more than the long life option. What about stock price volatility? What happens is as sigma increases, the stock price will do very well. The variability, the change, the movement increases. So as sigma increases, the chance of being very high or very low increases. The chance that it will do very well or very badly increases. So therefore, the value of both the call and the put increases as the volatility increases. And why? And effectively, why is that? Because owner of the call benefits from the price increases, but has limited risk in the event of the downside, in the event of the price decrease. Because the maximum he or she can lose is essentially the price of the option. Similarly, the owner of the put benefits from price decreases, but has limited downside risk in the event of price increases. So obviously, on both sides, when the option can be exercised, this variability increases. Therefore, the profits on that scenario increases. Whereas on the other side, the downside risks are limited and the downsides do not change. So both therefore because the maximum loss you can incur is only the option premium, and hence both the call option and the put option prices increase both for European and for American options. And you can see the graph. What happens with the interest rate? What happens with the interest rate? What happens is, as the interest rate increases, the call prices always increase and the put prices always decrease. Why? Because as the interest rate increases, the expected rate at which the price increases also increases. The growth rate tends to affect the increase in the price, and the present value effect. However, the present value effect as R increases, the present value effect tends to decrease the price, because after all, S naught is nothing but ST into e to the power of minus RT. But the growth rate typically always dominates, and hence the price increases. If the price increases, remember the value of the call should increase, and by the same logic as the value of the put decreases. So you can actually also look at the put from the other side. As the interest rates increase, the growth rate of the price of the stock tends to increase, but the present value of the future cash flows received by the holder of the option decreases. Now, these two effects both tend to decrease the value of the put option, because the net effect, the price increases. If the price increases, the impact is negative, or for the impact is positive for the call option, negative for the put option, and that is what happens in that process, and that is how it kind of goes down. And you can see the graphs. Now we will move on from here. Okay, we'll talk about this also very quickly, and then we'll move on. So basically, dividends have the same effect as reducing the stock price on the ex-dividend date. Therefore, if you take the present value of that today, that will cause the price to go down. Now, if the prices go down, remember, they're opposite. The prices go down, the call will also go down, and the put will go up, because it is effectively a size matter. So as the dividends increase, the impact of the dividend, the present value of the dividend today becomes large, and therefore S naught minus the present value of dividend, the spot price has a larger call today. So as the spot price goes down, as the current spot goes down, remember we said in the very first instance, the call price will therefore go in the same direction, which means call prices will go down and the put prices will kind of go up. And that is exactly what happens in this process. Okay, now we will stop here with this, and we will move on to the boundary conditions and all that. The reason why I don't want to do more than this at this point is, if not today, tomorrow I will do the pricing of the options. And when I finally do the Black-Scholes pricing of the options, what I will show you through the Black-Scholes pricing and then the model is how each of these statements that we have made can be shown to be true mathematically. At this point, we have just tried to explain them descriptively to show that this relationships hold. Now, I will subsequently show you through a mathematical exposition as to how this exactly the same statements that we have made hold good in practice. So we will kind of look at the proof or look at the justification of it using the Black-Scholes option price. But to do that, we first introduce the Black-Scholes option price. We will do the Black-Scholes option price a little later. First, let's talk about this basic, option structures and all of that, and then we will kind of come back to the other part. Now, what I want to talk about out here is that can I have? So, I mean, I have these option prices. Can I put some bounds to these option prices? So, can I have an upper bound and can I have a lower bound to these option prices? And the answer is yes, I can. But these numbers will be different for call options and put options. So how do I show that what are these bounds, and how do I calculate these bounds? And then how do I show what happens if the bounds are violated? What could happen if I claim something with upper bound or I claim something to be the lower bound? What happens if these bounds are violated? In the first place, a call option can never be worth more than the stock. Because remember, the maximum amount you would at any point in time pay is the value of the stock. Because after all, you remember, by buying a call option, you have the right to exercise it as long as the price is less than that. So if I charge the maximum I can charge you is the entire value of the stock upfront. Again, that will not be very feasible, but hypothetically, that's the maximum I can charge you. and therefore the value of the call option, the maximum value that you'll have paid the call option is the value of the stock. Now, interestingly, what happens is, and this is a slight interesting thing because in the put, it does not happen, it changes. The value of the call for both the European and the American, sorry, the upper bound for the call for both the European and American is the same value as S0. So in both cases of European option or in American option, the upper bound is S0, which is, and what is S0? S0 is the current value of the stock price. So the maximum, because think of it, you want to buy the stock in the future. So the maximum you will be ready to pay is you can buy the stock today and hold it. So why will you pay? I mean, if I charge you anything more than today's price, why will you pay that? So the maximum amount that you will pay is the value of the stock today, and therefore for both the European and the American call, the maximum amount that you will pay at any point in time is nothing but the current value of the stock. There's a small difference that happens in the case of the put options. And what is the difference? The difference is, as you can see, while for the call option, while for the American put, the upper bound is still the strike price. For the European put, the upper bound is the discounted value of the strike price. So for the American call, the upper bound is the current spot price. For the American put, the upper bound is the strike price. For the European call, the upper bound is the spot price today. For the European put, the upper bound is the present value of the strike price. Why? Because remember, the maximum you would pay is essentially K. If you exercise the option, realize if the price has gone below, by selling the option, by the maximum you would be getting benefit is K. Now, in the context of, in the American option, you have multiple exercise dates. You can exercise it today, tomorrow, over the entire horizon. Whenever you exercise, you get the same amount K. There is no adjustment in the fact that whether you exercise on the first day or the last day, you still get the same amount K. On the other hand, in the context of the European option, you can only exercise on the last day. You cannot exercise it in an earlier date, earlier to the maturity date. So if you can only exercise on the last date, and on that day you will get K. There is no possibility of you exercising earlier than the last date. So in which case, right? So in this case, obviously, in the case of an American put, it is going to be K because it doesn't matter which day you exercise, you still get the same amount. If it is on for the European option, you can only get K, you exercise it and you get K only on the maturity date. So I get K at T, there is no possibility of exercise at any other point. So how much will be the value today? The value today will be the present value of K, and that is why I have that. And that is a small difference. Now, what we can show is if these conditions are violated, if these conditions are violated, you could make an arbitrage profit. There could be an arbitrage profit by writing the option and investing the proceeds of the premium at the risk-free rate, and therefore you could kind of make an arbitrage profit. We also want to calculate the upper bound. Sorry, we've calculated the lower bound. We also want to show the upper bound. What did I say? We've shown the upper bound. Now we want to show the lower bound. So I will do it for the European call, and NDPS stands for non-dividend paying stock. So I'm taking a scenario where the stock is non-dividend paying at this point, and I'm calculating based on the non-dividend paying stock. So the lower bound basically, so here remember it was the upper bound. So call had to be less than or, so here there was the upper bound, call had to be less than or equal to. This is the lower bound, so the call is greater than or equal to this number. So basically I'm saying that for the call, for the European call, the minimum value of this option price should be S0 minus K to the power of minus RT. The maximum value could be S0. So the option premium has to vary between S0 into the power of minus KT, S naught minus K to the power of minus RT and S naught itself. What will happen if this gets violated? So let's see this example. So let's say this is an example that I have. So I have given you those numbers. So let's say the spot is $20, strike is $18, interest rate is 10%, time is 1 year. So I calculate the right hand side, which is S naught K to the power of minus RT, and that gives me a value of $3.71. Let's suppose for some strange reason the call is available. My calculation shows the minimum value of the call should be $3.71. However, for some strange reason, the call is available in the market at $3, which is lower than my theoretical minimum. So I'm arguing an arbitrager can make profits out of this. So what can the arbitrager do? Can buy the call and short the stock. So to buy the call and borrows the stock and sells it, it's non-dividend paying. To how much will be the cash inflow therefore? He buys the call, the current call value is 3 minus 3. He sells the stock is 20. So 20 minus 3, he gets a cash inflow of 17. He earns 17. He puts 17 at 10% for a year in a deposit. That at the end of the year gets him 18.79. Now that is guaranteed cash for him. At the end of 1 year, the option expires. When the option expires, I do not know whether the asset price is above 18 or below 18. It can be any of the two. Let's assume that it is greater than 18, which means what? I will be able to buy the stock at a price of 18 when the market has gone above 18. And where do I get the 18 from? Remember, my investment has got 18.79. So out of the 18.79, I go and use 18 to buy the stock, which I use to close out the short position in the stock. And I'm left with a profit of 0.79. This is what happens when the stock price goes up. If the stock price goes down, what happens? I will not buy the stock in the option. I will buy the stock in the market because I can buy it at a price cheaper than 18. And where will I get the money? Remember, I had 18.79. So if the price goes below 18, I can easily use the money from 18.79 to buy it and make. So on the other side, I will only have a profit of 0.79. But in this case, the price has gone below 18. So I'm buying it at a price below 18. Maybe if I buy it at 17, I'm making a profit of 1.79 and so on. So I will always make a profit in that sense. And therefore, the arbitrager makes an even greater profit. The only thing is here, and that will kind of not happen in the next case. In this case, the minimum profit is therefore 0.79. The maximum profit is 18.79. And where did I get it? Because realize the minimum profit happens when the asset price has gone up, the call is exercised, and therefore I will buy it at 18 and pay the 18 out of the 18.79. And therefore my profit remains constant at 0.79. When the price goes down, I buy it at a price cheaper than 18, and therefore I make a larger profit. So hence and the worst case that can happen is the price goes down to 0. So I will be able to buy an asset and the asset becomes worthless, which means I will be able to buy it at a price of 0. But I have 18.79 with me in my pocket with me, so my profit becomes 18.79. So irrespective of what happens, I make a profit, and therefore I have I make an arbitrage profit. Now this is the formal proof. Again, I have the same problem that has come about out here. But anyway, let me take the two portfolios. I take a portfolio of A, which is an call option plus an amount equal to the cash. So I have a call. So basically, I take a portfolio where I buy the call option, hold the call option, and I hold cash, enough cash today to be able to exercise this option in the future if need be. How much would I need to exercise the option? I would need K. So therefore, today I hold present value of K or K to the power of minus RT. Portfolio B has only one share. I want to show that these are equal, and then look at that. So what is the value of portfolio A at maturity? Remember, it's a 3-month option or whatever. So on maturity, what will happen? I will be able. So two things are happening. First, the option will mature, and that will come to. But the present value of the strike price that I get has increased and has today become equal to the strike price. Now, if the option matures, and if the option matures being in the money, which means what? I will pay out, I will be able to buy the asset by paying out the strike price, and the asset value is more than the strike price, so I will get an asset value ST. If the price is less than, if the market price is less than the strike price, I will not exercise the option, and I will buy, I will therefore hold the cash, I will still have the cash amount left with me, and therefore I will have the strike price. So therefore I will get the maximum of the strike price and the asset price. On the other hand, portfolio B is only the spot, only the asset. Asset price is changed, moved from S0 to ST, and I have the asset price. Now, if my left hand side is equal to ST, then the portfolio to A and portfolio B are equal. If portfolio A is max of X in K, therefore if portfolio A is K, then portfolio A is greater than portfolio B. So therefore now you combine all of it and you see that portfolio A can never be less than, will always be greater than or equal to portfolio B. Now, this is in the future. Discount the portfolio values to today. So basically, today they should also be the same. Not the same, sorry, the relationship should hold the same. So you will end up getting K to the power of C, which what is today, the current option plus the present value of the strike, should therefore be greater than or equal to the value of the spot today. And then if you rewrite, therefore it becomes C should be greater than or equal to S naught minus the present value of the strike price. So that's what will kind of happen. Now, because the worst that can happen is the call that expires worthless. Its value cannot be negative, and hence C is right. Now, because the worst that can happen is that it expires worthless, its value cannot be negative. So now if I write it down, C will be greater than or equal to the maximum of this and 0 because the negativity cannot come in. Similarly, for the put option, this has to be greater than or equal to K minus e to the power of RT, K e to the power of minus RT minus S naught. So that is how that will kind of work. Again, I have done the same example. Again, I've done a similar example, but with different numbers. So if you look at that, the first side, K to the power of minus RT minus S naught gets you a value of 2.01. Let's say the market has somehow quoting a price of $1, which is less than the theoretical minimum. So what will I do? I will buy the stock and the put option. But to do this, I need to borrow. How much do I need to borrow? The current price of the stock is 37. The price of the put in the market is 1. Therefore, to borrow, I need to borrow $38. And I will I buy both the put and the stock. At the end of the 6 months, now I have borrowed $38. Now, irrespective of what happens at the end of the 6 months, I'll have to repay the $38 plus the interest on it. So therefore, I will have to repay 38 into e to the power of RT, R being 5%, T being half a year. So for the borrowing of 38 under these numbers, I will have to repay $38.96. Right? Now, on the maturity, also what happens to the option? If the stock price, now remember, I have a put option, I have a stock. If the stock price goes below $40, which is the strike price, the stock that I've bought, I will sell that in the auction. So, which means what? I will be able to sell it for the stock. I'll be able to sell it for 40 when the market is below 40. I will take this 40 and repay the 38.96, and therefore I make a profit of 1.04. Right? If the stock goes above 40, what happens? I do not exercise the put, which means I do not sell it in the put. Right? So that is what happens. So you get a profit of 1.04 when the price goes below 40. When the price goes above 40, what happens? You don't sell it at 40, you sell it in the market at the market price, and out of that you pay out 38.96. So since the price has gone above 40, your profit is 1.04. plus the amount by which the price has got above 40. Now, how much can the price go up to? The price can technically go up to infinity, and therefore you can actually have a very large and infinite profit. So, but that is not what I mean. While that is one part of the story, but the argument is that in both scenarios, if either irrespective of whether the price goes up or the price goes down, you can make a profit, and therefore there is no arbitrage. Sorry, therefore there is an arbitrage possibility that kind of comes in. It is, in that whole thing, right? And then I can simply show the same thing mathematically as I did earlier. I take two portfolios, C and D. In one case, I put the put option and I put a share. In the other case, other side I put a cash amount equal to the present value of the strike price. For the first one, what happens on maturity? If the asset price goes above the strike price, then I will not exercise the put option. I will simply hold on to the share, and therefore the value of the share will be ST. If it goes below the strike price, I will exercise and I will get an amount K. Therefore, my portfolio value will be maximum of ST and K. On this side, on portfolio D, I started off with an amount of cash equal to K to the power of minus RT. Therefore, on maturity, how much will it be? K. So now, therefore, my portfolio C is either ST or K, whichever is higher. Portfolio D is only K. Therefore, C will be greater than or equal to D. This is in the future, discounting to today. So therefore, it has to be the same. So therefore, P plus S naught has to be greater than or equal to K to the power of minus RT. Reorganize, you get P is greater than K to the power of minus RT minus S naught. Right? Now, what is the worst case that can happen? The worst case that can happen is the put option, it expires worthless, because after all, option value cannot be negative, or option premium cannot be negative. This essentially means that P will be greater than So this essentially means that P will be greater than the max of K to the power of minus RT minus S naught and 0. So what you see is that if these are the upper and the lower bounds, and if these gets violated, you automatically have arbitrage possibilities. And you can't generate arbitrage possibilities in the market to start with, and therefore you will not do that. Okay. Now, I did this for the European options, lower bound. What about the American options? So the American option is easy for the American option, the call is easy. It is never optimal to exercise the American call early. This is because if you are a holder or an owner of an American call, you have all the exercise possibilities open to you. And all the exercise possibilities open to the owner of the corresponding European call. And therefore, the price of the American call should be more than the price of the European call. The European call minimum price is S naught into the power S naught minus K to the power of minus RT, as we saw. Therefore, out here also, the American call will also have the minimum price of that. And given that R is positive, interest rate, remember, is positive. So R e to the power of minus RT is therefore less than 1. So that kind of reduces that. If I drop that, then it follows that the equality gets dropped and you have C will be greater than S naught minus K. When it comes to the American put, it is all, now this is difficult. Theoretically, this is correct, but this kind of becomes difficult to show, because what we are saying is it is always optimal to exercise an American put immediately when the stock price is sufficiently low, provided R is greater than 0. Now, this is correct, but the uncertainty and then the problem out here is what is sufficiently low. We are saying it has to be sufficiently low, that is fine. But what is the definition of being sufficiently low is something which is not explicitly clear. Is 10 low? Is 100 low? Is 1 low? I don't know. Right? So therefore, so that kind of makes it a little vague. But for an American option, when the early exercise is optimal, the value of the option is K minus S naught. Hence, P has to be American option price has to be American option price has to be greater than K minus S naught. But this exercise part is a little tricky. It's very difficult to justify that upfront in that sense. But what is not a problem is this one, which is a put-call parity equation for European options. Please realize this is a put-call parity equation for European options. And what we are saying is that, is a call option equal to a put option? So is holding a call and holding a put, is it the same? And the answer is no, it is not, but it is related to an equation which is given there. So what the equation is, call plus the present value of the strike price is equal to the put plus the current value of the spot, right? So what do we do? We are basically, how do I prove this? So remember, I had those portfolios. So I take the portfolio A, which is call plus the present value of the strike price. I take the second one, which is put plus the spot. And both are European options, so no early exercise or anything is possible. So what happens in maturity? In portfolio A's case, the present value of the strike price goes to K. The call, now if the spot price is greater than, if the spot in the market is greater than the strike, which is the call is in the money, I will exercise the call, pay the strike price, and in return get the spot whose value is ST, which is greater than K. In case the spot is less than strike, then I will not exercise it, which means I will be left with the strike price with me. So I will have my portfolio will be worth the maximum of ST and K. What about the other side? I have the spot, I have the asset, and I have the put. If the asset price is less than the strike price, I will exercise the put option and I will get the strike price. I will earn a strike price. If it is more, then I will do not. Then I will kind of do nothing and hold on to the strike, hold on to the asset, which means I will have a value ST. So therefore, again, I will get a portfolio which is worth a maximum of ST and K. So now I have a scenario which is at maturity, both have the value, which is maximum of ST and K. Two portfolios are equal at a future point. I'm discounting them at the same rate. There is no arbitrage opportunity. I'm multiplying it by the same rate. So therefore, when I discount it back today, I multiply it by the same amount K, same amount of on both sides. So the portfolios have to be equal today, which means C plus K to the power of minus RT will be equal to P plus S naught. Now, what will happen if this equation gets violated? Well, if this equation gets violated, what will happen is that you will have arbitrage possibilities. How do I show that? Let me show you these two examples. So I have these data. You see, you can have spot, strike. So what do I have? I have the call option price. I have the spot. I have time to maturity, interest rate, strike. I'm ignoring dividends, so dividends does not come into the picture. Right? So the question that I want to ask is, what are the arbitrage opportunities? There are two scenarios that I want to show. In one case, the put price is 2.25. In a separate scenario, the put price is 1. What are the arbitrage opportunities in both these cases? To take the first case, right? P is 2.25. So I am calculating the two sides. C plus X to the power of minus RT is, if I plug those numbers, I end up getting it to be 32.26. If I plug the other side, I get it to be 33.25. Thus, what I'll end up getting is that the second portfolio is more expensive or overpriced with respect to the first portfolio. My argument is that if this happens, there is an arbitrage to be made. And if there is an arbitrage to be made, what should I do? My strategy should be sell the more expensive portfolio, buy the cheaper portfolio. So in this case, I should sell portfolio I should sell portfolio B and buy portfolio A. But buying portfolio A would typically include buying cash. I cannot buy cash, so I only buy the option. So what happens if I buy the option? I have to pay $3. By selling portfolio B, I earn 33.25 because I earned by selling the put option. I earn 2.25. Selling the asset, I earn 31. So I earn 33.25. But I also pay $3 today. So my net income is 30.25. I invest this for a 3-month period at 10%. Therefore, this kind of 30.25 will naturally grow will become with interest 31.02. On maturity, now on maturity, the stock price can be greater than 30, can be less than 30. Remember, 30 was the strike price. So I do not know what it will be. If the stock price is greater than 30, remember I have a call. I will exercise the call, which means I will buy the asset at 30 when the market price is more than 30. Where will I have the 30 from? Where will I get the 30? Remember, I have 31.02 in cash. So I pay I pay 30 out of the 31.02, and therefore I am left with the 1.02. With the asset that I have now got, I will close out the short position that I had created earlier on the other side of the portfolio. The put expires worthless. When the price is less than 30, the call expires worthless. But what has happened? Remember, I have sold the put, which means somebody will have the right to come and sell the asset to me at a price of 30 when the market price is more than 30. Sorry, market price is less than 30. The call expires worthless. So which means I will still have to buy the asset at 30 and I pay the 30 from 31.02. And with the asset that I acquire, I close out the short asset position. So irrespective of what happens, therefore I land up with a profit of 1.02. And hence that becomes an arbitrage profit for me, which is what I make in this context. This is when the put option price is more. What if the put option price is less? So this is the case when portfolio B is more expensive with respect to portfolio A. Why do I take P equal to 1? I take P equal to 1 to show that if portfolio A is more expensive with respect to portfolio B, I can still do the same. Right? So I do the same computation and now I find portfolio A is more expensive than portfolio B. So I do the same strategy, which means I sell the more expensive portfolio, buy the cheaper portfolio. Now here, since I buy the cheaper portfolio and I have to buy portfolio B, I buy the put option and I buy the asset. How much will that cost me? That costs me 1 for the put option, 31 for the spot. For the asset, therefore I pay 30. I need 32. When I sell portfolio A, I cannot sell cash, so I sell only the call option, which means I earn only $3 from there. So my net amount that I need to borrow is, I need to borrow 32 to buy. I have got $3. So therefore I borrow $39, sorry, $29. Now, irrespective of what happens to my strategy, this $29 has to be repaid after 3 months at at 10% interest. So therefore that works out to be 29.73. So at the end of 3 months, my liability is of repayment is 29.73, irrespective of what happens. That's one side. Now I go into the options. If the price goes above 30, what happens? If the price goes above 30, I will have to sell an asset for 30 when the market is more than 30. Where will I have the asset? Remember, I've already bought the asset. So I will sell that asset for 30 and I earn 30, use that 30 to pay out the 29.73 and make a profit of 0.27. If the price goes below 30, the call expires worthless. But now I have the put option, so I will be able to sell it to somebody at 30 when the market has gone below 30. So again, irrespective of what happens, I sell the asset for 30. Right? And I earn so I earn 30, I pay out the 29.73, so I make a profit of 0.27. Again, there is an arbitrage profit that I kind of make at all points. Right? So therefore, if the put call parity is violated, I will end up making an arbitrage profit, as you can see in the whole process. Now, in practice, what would this mean? Like I said yesterday, or I don't know, probably yesterday or maybe earlier, I can't remember, that if you have an arbitrage profit, the first mover will get the advantage, but subsequently the market will correct itself. Now, you can argue that one of the things I've ignored in all of this equation, and all this computation, is I have not taken into account any, transaction costs, taxes, or any transaction costs, and therefore, adjusted for transaction costs, this 20.27 might be too small an amount for you to make profit. That can happen. So that in that case, what will happen is the market will correct itself, but it will not correct itself fully, because in fact, in practice, it will correct itself only to the amount at which an arbitrage profit is not feasible any longer, subject to transaction costs. So if in this example, my profit is 0.27, but the transaction cost of buying and selling maybe $2. Therefore, to get the profit of $0.27, I will actually have to pay $2. There is really no point in doing that. So therefore, I will not claim that correction will not effectively happen. But if the cost of doing that was less than 0.27, then obviously the market has to correct, because then otherwise I will obviously be able to do this arbitrage profit. Finally, I have done this for I've done this only for non-dividend paying stock. You can add a dividend paying stock if I know the dividend. So essentially, as long as I know the present value of the dividend, I can include it. What do I need to do? All I need to do is wherever I have an S0, I should actually go and subtract the present value of the dividend from the S0. So in the lower bound of the call options for European calls will be C will be greater than S0 minus D minus K to the power of minus R. For the put, it will be K to the power of minus RT minus S0 and minus of minus D plus D. So that's how the plus D becomes. For the put call parity, the same thing. The equation was C plus K to the power of minus RT is S minus P plus S0. Replace S0 by S0 minus D and then take D on the other side, you get this. Finally, with the American option, that is the relationship that you get. Now, with an American option, you cannot get a closed form solution. What do I mean by a closed form solution? You cannot get an equality of the types that we were getting earlier. Why is that? Because remember, in an European option, either the call or the put can be exercised. Both cannot be simultaneously exercised. Because only one will be in the money, the other will automatically be out of the money. However, in the case of the American option, what can happen is, during the life of the option, on a given day, the call can be in the money. On a different day, the put can be in the money. And therefore, both can be exercised, but at different days. But within the life of the American option. In which case, this equality and this whole argument that only one can be exercised does not hold. And that is where the equality does not come into picture. And that is why we have this inequality that shows up. Okay. Okay, very quickly, let's look at a few of these problems, and then we will move on to the other side. We'll take a break, and then we'll start with the other part. What do you think will be the answer to this? Now, obviously, you can calculate it. The formula is there, you can calculate it. But look at it, but be, don't try to compute everything. Just be a little intelligent. You see, the current price is 12, the strike price is 15, and it's a put option. Can effectively the price be more than 12 or 15? The answer is no. Therefore, B and D are automatically ruled out. At the current point in time, the difference between the strike, which is a future value, and the spot price is 3. Now, if you discount the 15 to today, it will be a value less than 15. So therefore, the lower bound will actually have to be a value less than 3, which is 2.926. The answer is C. Now, obviously, you can do it that way, or you can calculate the lower bound. This I've actually gone and calculated the lower bound using the formula, which is K to the power of minus RT minus S0. So obviously 15 e to the power of minus 6%. Interest rate is 6%. T is 1 month, so 1 by 12 minus S0. If you solve it, you get 2.92. But honestly, I did not need to do this. I could have got it directly from there by thinking of it in the manner that I kind of spoke about. What happens here? 4-month European call option on a dividend paying stock, currently selling for $5. Stock price is 64. Strike price is 60. Dividend of 0.80 cents is expected in 1 month. Interest rate is 12% per annum. what happens? This is what happens. I don't know why this is yellow. Why this is highlighted, I have no clue. Suddenly. So what is the explanation? So the answer is buy the option, short the stock, and you will get a profit. But how? Look at this. What is the present value of the strike price? Remember, 60 is the strike price. So the present value of the strike price is 60 into e to the power of minus RT. R is 12%, T is 4 months. So therefore, 60 into e to the power of minus RT. So I get present value of the strike prices 57.65. Now, what is the present value of the dividend? The present value of the dividend is 80 cents, 0.8, discounted by 1 month, right? I mean, I'm sorry, there's a typo. It is not 0.3333. It will be 1 by 12 into 0.12, and that becomes 0.79. Now, the price of the option is $5 in the market. What should be the theoretical price of the option? K minus S naught minus K to the power of minus RT. And S naught, you'll have now, since dividend is there, you have to subtract the dividend. So S naught minus D minus K to the power of minus RT, which is 64. S naught minus 57.65 minus 0.79. So if you do that, that number is more than 5. So the value of the option, so basically the lower bound is kind of being breached. So the equation that call has to be greater than this is getting violated because the market price is only 5, whereas it should actually have been higher than 5. So you buy the option and short the stock. So now what happens if this price goes below 60? The arbitrager loses the $5 spent on the option. But how much does he gain? He gains at least 64 minus this, minus 0.79, which is 5.56 in present value terms from the short position. If the stock price goes above 60, the arbitrager gains 0.56. So on both sides, the arbitrager gains at least some amount, and therefore there is a positive profit that happens, and therefore he makes money, and he will, obviously there is a arbitrage profit to be made. What about this? Non-dividend paying stock, currently selling 1 month put option, currently selling for $2.5. Stock price is 47, strike price is 50, risk-free interest rate is 6%. What happens? Again, look at the lower bound. So what is the lower bound? Sorry. What is the present value of the strike price? 50 to the power of minus RT. And this is R is 1 month. So again, I have made a mistake out there, which should be 0.0333. It is 1 by 12 into 0.06. So 49.75. Now 49.75 is the so the lower bound should be greater than K to the power of minus RT minus S naught. So 49.75 minus 47, which is 2.75. But the option price trading in the market at 2.5, which basically means the equation P should be greater than max of K to the power of minus RT minus S naught, and 0 is getting violated. So in that track, so that means that the difference, the 0.25 cents, is what I can guarantee to be buying and I can do that by buying the put and buying the stock. And irrespective of what happens, I will make this money in the future. You have a call and a put option with both the same strike price 20 and the same expiration date, maturity date 3 months from now. Both prices are the same $3. Interest rate is 10%. The current stock price is 19, and there's a $1 dividend expected in 1 month's time. What is arbitrage opportunity? Okay, if the call is worth $3, the put call parity shows. Use the put call parity, and for it to be a and we have a dividend, you can adjust for the dividend. The put should be worth 4.5. Now this is obviously greater than the $3 the put is being charged. Therefore, the put is therefore being undervalued relative to the call. So the correct strategy would be the put is cheaper, buy the put, buy the stock, short the call. This one, let's say there are three options, C1, C1, C2, C3, all three are call options with strike prices K1, K2, K3, such that K3 is greater than K2 is greater than K1. And K2 is the midpoint. So K2 by K3 minus K2 is nothing but K2 minus K1. All options of the same maturity. What we need to show is that the C2 is less than equal to half of C1 plus C3. This is basically what will show up subsequently as a butterfly. So what happens? Let's consider an output portfolio that is long one option with a strike price of K1, long one option with a strike price of K3, and then short two options with strike price of K2. What will happen when ST, what is the payoff? When ST is less than K1, none of the options will get exercised and therefore the payoff is 0. When ST is between K1 and K2, the payoff is, because remember I've gone long, so the payoff is ST minus K1, which is positive. ST is greater than K1, so I have a positive thing. When it goes between K2 and K3, the one bought option will give me money, so I will get ST minus K1, but I will lose on two options where the payoff will be where I'll lose. So I've shorted the option, so I'll lose which is basically ST twice of two options, minus 2 ST, 2 times ST minus K2. But if you expand that, that becomes what? ST minus K1 minus 2 ST plus 2 K2. But also I know K2 minus K1 is nothing but K3 minus K2. So therefore I can write the K2 minus 1. So I can write K2 minus K1 plus K2, right? Which is nothing but K3 minus K2 plus K2. So the K2 and the K2 cancels out. So you end up getting K3 minus ST. But K3 is greater than ST, therefore that is positive. And when the asset price goes above K3, all the options will exercise. So you get ST minus K1 minus twice ST minus K2 plus ST minus K3. If you write it out, you'll see, or it will cancel out because it will be K3 ST minus 2 ST plus ST. So the STs cancel each other out. Then you get minus K1 plus 2 K2 minus K3. So that is K2 minus K1 minus of K3 minus K2. But as we wrote down earlier, being the midpoint, K3 minus K2 is equal to K2 minus K1. So therefore that equates out and that goes to 0. So therefore I have the payoffs kind of structured in that manner. So this shows the value will always either at the two ends be 0 or positive. So at any expiration, any point, the value is 0 or positive. In the absence of arbitrage possibility, it has to be 0 or positive today. So therefore C1 plus C3 minus 2C2 has to be greater than or equal to 0, or C2 has to be less than or equal to C1 plus C3. Okay, that's how I've got that. This is interesting because this is essentially the moving on how the Black-Scholes kind of comes up. So look at this. This is kind of interesting and easy to understand also. You are a manager and the owner of the company. That you have a debt. Debt will expire or debt will mature in 1 year's time. Now, if at that time the value of the company is more than the value of the debt, you will repay the debt. In case the value of the company is less than the debt, you will declare bankruptcy and give over the company to the debt holders. Right? How will you explain? How can this be written down as an option on the value of the company? Also, the position of the debt holders as an option in terms of the value of the company. And what can you do to increase your position? So look at the first one. How do you write down your position as an option on the value of the company? So let's look at this. Let's say V is the value of the company and D is the face value of debt. So on maturity, what will happen? How much will you pay? Max of V minus D and 0. If V is greater than D, remember, if the value of the firm is greater than the value of the debt, you will pay that out. So that will kind of give you V minus D. If D is greater than V, then V minus D is negative, but you will lose the company, therefore it becomes nothing but 0. So this is basically a payoff from a call. So therefore this translates to be nothing but payoff from a call option on V with a strike price D. This is your position. Now let's look at from the debt holder's position. On maturity, how much do the debt holders get? They either get the face value of the debt or they get the company, whichever is lesser. Remember, you get the debt face value of the debt. If the value of the company is less than the is more than the debt, because then the debt is repaid. If the value of the company is less than the debt face value, the company is given over. So I get the minimum of V and D, which is nothing but D minus the maximum of D minus V and 0. Because if you look at the D minus V, what is happening? It is nothing but a put option on V with a strike price of D. So when V is greater than D, you are getting max of D minus V and 0, which is max of minus term and 0, so it is 0. D minus 0 is D, so you get D. If D minus V is if D minus V is positive, what are you getting? You're getting D minus V. But that means you're getting D minus of D minus V. So D minus D plus V. So you're getting the company which is less than D in any case. So you're going to get, in effect, you get it's nothing but a put option. Max of D minus V is a payoff from a put option on the value of on the value of the firm with a strike price of D. So debt holders in effect have made a risk-free loan worth D at maturity with certainty, and written a put option on the value of the company with a strike price D. Now, the position of the debt holders in 1 year can also be written down as V minus the maximum of V minus D and 0. Again, the same thing will happen because this is a long position in the assets of the company combined with a short position in a call option on the assets with a strike price D. Now, this is kind of nothing but, and if you want to show this, this is nothing but the call and the put equation, which kind of matches, and the put call parity kind of works. Finally, so the last part of the question was, what can you do to increase the value of your position? So what can you do? You can increase your position by increasing the value of the call option in A. That is by increasing V or the volatility in B. Remember, we said as the volatility increases, the value of the call option increases. As the spot price increases, the value of the call option increases. So the way I can do it is I can either increase the value of V, or I can increase the volatility in V, or I can do both. Now, to see why V is beneficial, this is it. What happens if V becomes large, or if you take large risks? As V increases, the extra benefit comes to the, remember, you only pay back D. So as V increases, you only pay back D. V minus D, which increases, is your profit. So you benefit. In case V decreases, in case V falls, in case V crashes, what happens? You are not required to pay anything more because you will just hand over the company. And therefore, the loss to you is still the same. So the downside is kind of borne by the company's lenders. The upside, debt holders, the upside is borne by you, the company's owner or the manager. And therefore, all that you will do is you will get into more riskier and riskier projects, because if they come through, if they work out, then you get a higher profit. If they don't, your loss is the same, which is the value of the firm. So you really don't have a problem in that. That is how you would do it. Okay, so that takes care of this. Any questions? Any questions? Any questions? Okay, if you don't have any questions, let's take a break. We will take a 15-minute break and we'll start back. So it is what? It is about 9:15 for you, 9:16. So we'll start back around 9:35, 9:30, 9:35 your time. Let's take a 15-minute break and we'll start back. Okay? That's fine? So I'll put the thing on stop recording, pause recording. We'll start back in. Are you guys back to start? Shall we start? Yeah, okay, good. So the next bit, before I do pricing, and I'll obviously not finish this, but let me start with this, and I'll continue with this tomorrow. So this bit is about trading strategies involving options. So what we are saying is that fine, we've done all of this. Fine, we know all these options and all of this. What do we do with it? And then our basic objective, remember, at the end of the day, is still managing the risk. So how do I manage the risk? What do I do so that I can manage my risks? And what kind of market conditions, under different market conditions, what can I do so that I can have a minimized risk position in the whole scheme of things? So this is what is essentially talking about. So this set essentially talks about that kind of a stuff. Some basic assumptions to start with. We discuss strategies which are European in nature. Because what we are going to do is we are going to create portfolios of call options, put options, call options or put options or calls and puts. So essentially we are going to create portfolios or options to take care of the market condition to kind of address the market issue. Now, given that, if I take American options, the problem is that, remember, realize, as we said earlier, the American options can be the same option. I mean, the exercise values or the exercise possibilities could become different under different scenarios over the same time horizon. Because remember, at some point the call might be in the money, at some point the put might be in the money. With respect to European options, the advantage is that all of them will only be in the money, or only not all, only the call or the put will be in the money. Both cannot be simultaneously in the money, and that is what we kind of look at. Another thing also is that we kind of ignore the possibility. We kind of ignore the time value argument simply because the benefit will still be the same. If you apply time value, you will be discounting both sides. So the value will come down by a small amount, but the impact will still be the same. And what we want to see out here is more the impact story. So we can obviously correct it for the time value side, but for all practical purposes, we just kind of keep the actual, as I said in the next point, the final payoff minus initial cost and not the present value of the final payoff minus initial cost. Right? Now there are various option strategies. We are not going to talk about all of them. We're going to talk only about a few of them. But if somebody is interested outside the class, do send me a message. I will make sure that I will kind of share more details with you. But there are a host of strategies that can happen. But the one that I want to cover is essentially these three scenarios. These are the three scenarios that we want to cover. So we want to do the first one, which is the set of options and the underlying. So I take a position in the option and I take a position in the underlying. Or that's one set I want to look at, and under which we have writing a covered call, reverse of a covered call, protective put and reverse of a protective put, and we'll talk about those. The second is what is called the spread option, the spread position, where we take a position in two options of the same, two or more options of the same type. So it is a portfolio of either only calls or only puts. Obviously, the options will be different, and we'll talk about how the options can be different in that scheme of things. And the last one that we talk about is the combination strategy, where we can kind of take both calls and puts, not just call or put, but call and put together. So these are the three broad frameworks that we want to kind of look at it. So in the first case, it is the option. One option could be call or put and the underlying. In the second case, it is different types. It is multiple options, two or more options, but of the same type. So it will be only calls or only puts. And the second case, it is going to be a mixture of call and puts. Right? So these are the three broad frameworks that we want to look at in this story. The first one, so if I go back and look at the first set, the first one is what is called as writing a covered call. What is a covered call? A covered call is essentially taking a position, long position in a stock and a short position in a call option. So therefore, what that results in, if you look at that, if you actually look at that, what does it result in? So the two dotted lines are the two positions. So the long position in the stock is kind of going this way, right? The short call payoff goes this way. The resultant payoff is this. And what is this payoff? This payoff, if you replicate it, if you think of it, is nothing but the payoff from a short put. So the writing a covered call is as good as equating it to a short put. Now, when would you do this? So if you have a short, if you have a short call, you can cover that by using a going long on a stock, and therefore you'll end up having, this is a simple risk management strategy that you can create, and therefore you have a covered call. What is the point of drawing the red line? The point of drawing the red line is, now if I want to value this option, value this portfolio, I have to value two different assets, the short call, the long asset, and then add them together to kind of get the value of the resultant position. But I can also see the resultant position is nothing but a short put position. And if I can see the resultant position is a short put position, I can simply value a put, and therefore I know the value of the portfolio. Now, two things. One is, you can argue that why do you want to do that with two assets? It is not that difficult to value the two assets. Do it, add it up. Yes, I can do that. But this is just an indication. If you have like 10 assets and 10 different things, or 15 different things, valuing each one of them, looking at the relationship between them may actually become very complicated. If I can simplify it down to one single product, one single framework, and value that, that becomes easy. And that is where the advantage of this lies. Now, how did I get, the next part of the question is, how did I get the red line? So what I did is I drew the two lines, the two dotted lines, and then I looked at, and for every point, I added the payoffs from the two dotted lines. And what I would therefore land up getting is, this is what I land up getting. So realize in the below K part, what happens? I am getting the I am kind of making a fixed profit in the short put. Sorry, I'm making a fixed profit in the short call, but I'm losing some money in the long asset. So the loss in the long asset is offset to the extent of the profit that I make in the short call, and therefore you see the line goes above. When it goes above K, what happens? This line keeps going up, but the other line starts coming down, and therefore I have a resultant difference. The difference is a constant, and therefore you'll end up seeing the flat part of it, which results in the short put argument. If this is the writing a covered call, what will be right? What will be the reverse of writing a covered call? The reverse of writing a covered call is essentially therefore a short position in the stock and a long position in the call option. And that results in the net result results in a long put position. So that translates to a long put position. So if you take a short position in a stock and a long position in an option, it kind of translates back into the red line, which is a long put position in the put. And again, I've done the same thing, and you can see that that is exactly how it will work out. Right? Fine. This is how this works. So this again, if you look at the same thing, the same story is happening. I'm looking at the difference between I'm adding the two, so where the profit and the losses are added together at every point, and the resultant diagram is the red line that I have drawn. And I kind of get a long put. So instead of valuing the two assets, I can simply go and value a put, and therefore it becomes easy for me to kind of see what the value of this portfolio is. These were with the call. So this was playing around with the call where I did a covered call, writing a covered call, which was basically a short position in a call, long position in the asset, or the reverse of writing a covered call, which is short position in an asset, long position in a call. Right? I can also play around with the put. And the put is basically called the protective put and the reverse of a protective put. So the protective put, what is it? I buy the put, I buy the stock. So I buy a put option in the stock, I buy the stock itself. What does it? And then therefore, again, you see the dotted lines represent the payoffs from the long position in the put and the long position in the asset. And what does it result in? It results in a long call. The net position results in a long call position, as you can see. The red line is nothing but the payoff from a long call. So therefore, valuing it becomes easier because you can simply value a long call, and that will kind of take care of the problem. Finally, the last one is the reverse of a protective put. What is the reverse of a protective put? The reverse of a protective put is a short position in the put option and a short position in the stock itself. Remember, the protective put was long position in the put plus a long position in the underlying asset, and that resulted in a long call. The reverse of a protective put is short position in the put, short position in the underlying asset, and this results in a short call. The red line kind of represents a short call. So therefore, you can now you can kind of play around with this. For example, if you had a portfolio of a short call and a short put, how do you protect yourself? You can protect yourself by going short on the asset itself, because then you'll end up getting the reverse of a protective put, and then get balanced. So obviously you can play around with each one of them in some form or the other to kind of get the other position, and therefore you can easily balance the thing out in that manner. Now, instead of looking at it from a diagrammatic perspective, which is what I've done out here, remember these are European options. So I could do something which is I could kind of use the put call parity to show these equations. So I can do the put call parity for each one of them. Now I know the put call parity is given by put plus the plus the current value of the asset is call plus the present value of the strike price plus the present value of the dividends. The present value of the strike price and the present value of the dividends is nothing but a cash amount. So it's a certain amount of cash. So in the first case, when you have the long position in the protective, the covered call was what? Long position in the asset, short position in the call. So therefore, basically, I am S0. I'm long on the asset S0. I'm short on the call. So I'm selling the call. So S0 minus C. So if you write S0 minus C, it is basically a short put minus, take it on the other side, minus P plus some cash. So short put plus some cash, which is what we got in the diagram also. Reverse of the writing a covered call. The reverse of writing a covered call is short position in the stock, long position in the call option, right? So that basically becomes minus S0 minus the short position in the stock, which is minus S0, plus a long position in the call, which is plus C. So it's C minus S0, which becomes what? The long put P minus a certain amount of cash. Because now if you take it on that side, C minus C minus S0 is P minus K to the power minus RT minus D. But K to the power minus RT minus D is some amount of cash. So therefore that can kind of equate out. And therefore you have P minus this amount. Similarly, for the protective put, long stock, long stock, long put is essentially that side. So it's basically nothing but long call plus certain amount of cash. And the last case was short position in the put, short position in the stock. So basically it is minus P minus S0. So therefore that becomes all minus. It's basically short position, short call minus a certain amount of cash that you need. So you can kind of write this, whatever we showed or whatever we saw out there from the diagrammatic representation, you can replace the same and you can kind of do it from here by using the put call parity framework and then work from the put call parity framework itself. Now this is the first bit. The second bit is the spread strategies. So before I talk about the spread strategies, I want to highlight one thing to you all, and that is, you see, let's go back to the option pricing framework in the basic option pricing model. What are the two things that you have a choice on? Remember, the option price is dependent on 5 terms: spot, strike, interest rate, time to maturity, volatility. Of this 5, you cannot choose the spot because that is defined by the market. You cannot choose the interest rate, that is again the market driven, and the volatility is automatically driven by the underlying asset. So you cannot choose these 3 yourself. These are automatic. Once you choose the asset, these are automatically chosen. However, you can choose the strike price and you can choose the time to maturity. The spread strategies are essentially playing about with the strike prices and the time to maturities in different scenarios. So in the first set, what we will do is, we will say that 4 of the 5 terms, which is spot, time to maturity, interest rate, and volatility, these 4 are the same. Now I will take 2 different options, one with strike price K1, the other with strike price K2. Now K1 can be less than K2, K1 can be more than K2. For simplicity here, I am taking K1 to be less than K2, right? Now, and I'm doing only call options. When I buy or sell, I'll come back to it later, but if I only do call options, realize the value of the call option with the lower strike price. Remember again, this is from the table that I showed you. As the strike for a call option, as the strike price falls, the strike price and the call option price are negatively related, which means as the strike price goes down, the price of the call increases. As the strike price increases, the price of the call decreases. So using that logic, if the option with strike price K1 will be more than the option with strike price K2. In other words, the option with the strike price, with the lower strike price, will be more expensive than the option with the higher strike price. Now let's kind of look at the strategy, and then I'll talk about why am I doing this. The strategy is, I buy a call with a certain strike price and I sell a call with a higher strike price. So the same underlying, everything else is the same. Now remember, I said the price of the call with the lower strike price is higher than the price of the call with the higher strike price. Further, if I buy, I pay the premium. If I sell, I receive the premium. So what is happening? I'm paying a higher premium, I'm receiving a lower premium. So my net premium is adjusted, but it is still negative because I've paid out more and I've received less. So the dotted lines, if you look at the 2 dotted lines, the dotted lines represent the 2 options that I have. The red line represents the resultant position. And what do I have in the resultant position? So now, if the asset price is below K1, none of the 2 options are going to be exercised. And therefore, how much will you lose? You will lose the resultant premium. That is what you lose. At K1, the first option comes into life, which means the bought option comes into life. What does it mean? Which means you can buy an asset at K1 when the market price is more than K1. Which means as market price increases, your profit keeps on increasing. And that is what you can see in the dotted line. And more importantly, you can see that in the red line also. Till you get to K2. At K2, what happens? Well, at K2, or as you cross K2, the sold option comes into life, which means the option that you have sold will now be exercisable on you. Somebody else can somebody else can now come and ask to buy an asset from you at K2 when the market price is more than K2. But what is the advantage for you? You have bought an asset at K1. K1 is less than K2. So you will deliver the asset that you bought at K1 at K2 at the price K2. So how much will be your profit? Your profit will, after the moment the asset price crosses K2, your profit becomes K2 minus K1, and that remains constant because after all you bought the asset at K1, now you are selling the asset at K2. So at all points your profit remains the same above K2. Now, when would you do such a structure? When would you think you would do such a structure? So where do you think the asset price should be for you to do such a structure? In that line, so should it be close to K1? Should it be below K1? Should it be bit above K1? Should it be around K2? Above K2? Where do you think should the asset price be for you to do the structure which will give you a payoff, which is represented by the red line? Where do you think should the asset price be? Where do you think should the asset price be? Take the payoff in this fashion. This is your fashion. So obviously here you're making a loss. This is zero. This is where you're making a profit. Now where do you think the asset price should be for you to do this kind of a structure? Where do you think asset price should be for you to make, for you to kind of say that okay, this, if this is the market view, I will do this kind of a structure. This structure, by the way, is called the bull spread. Bull spread using calls. You can also do bull spread using puts and bear spreads and all that, and we'll talk about that tomorrow. But let me just finish off today by finish by this question, the last question that I had, which is what will be your, what should be your market view for you to do this kind of a structure. So where do you think the spot price should be of the asset, where it will be useful for you to do this kind of a structure? Where do you think you need to be for this to be for you to make this? Can just wait for a couple of seconds, 10 seconds, 15 seconds, and see. Otherwise, I'll give you the answer. Okay, since none of you want to try and it's late in the evening, I know it's quite late for you all. It's close to 10 o'clock. So let me just quickly finish this and then take 10 shut down for the day. Your expectation is that the asset price will be somewhere close to K2. Because you see, if it is significantly above K2, you are making a profit. But you are making an opportunity loss, because if you expected the price to be here, you should have gone on this product and you should have made a huge profit here. Whereas you are only making a small profit out here. So your expectation is that the price is going to be somewhere close to K2. Why? And what is the benefit? The benefit is that you are making a reduce because of this. Because if it is around K2, you could say I'll go with this. But then you are paying a larger premium. See, the net premium is large because you expect it to be around K2, and this is the range, right? The between here and here, your premium is lower. So if you expect the price to be around K2, you would do this because this would reduce your cost of buying the option. Your premium cost would go down, and you would still have managed to kind of get the same kind of profit, the same kind of return that you would make otherwise. So this would be a cheaper way to arrange to get to the same kind of cost, and that is why you would want to do this. If the price is too high, then this does not make sense, and if the price is too low, then none of this makes sense. So your expectation is that the price will actually go up, but it will not go up very much. It will be somewhere around K2, somewhere in and around K2, so that you and then the reverse option will allow you to reduce your cost. So you will make the same amount of profit, but for a reduced premium. Right? That is the utility of this kind of a product. So the utility of this kind of a product is fundamentally in that sense that you are able to make a reduced you're able to make the same amount of profit, but for a reduced cost. Okay. Okay. So before I close, we will discuss this tomorrow, but I think I want, so This is the payoff structure that I am kind of, so whatever I drew out there, this is where it is. If it is above K2, payoff from the long call option is ST minus K1, payoff from the short call option is K2 minus S2. Therefore, it is, if we add these two together, ST cancels out, so it's K2 minus K1. Between K1 and K2, it is only ST minus K1. Below this is 0. Right? So obviously, therefore, this is kind of a strategy where you have the call option, the strike price equal to K1, and has chosen to give up some upside potential, because remember, it could have gone up some upside potential by selling a call with a strike price K2, where K2 is greater than K1. In return for giving up this upside potential, what does the holder get? The holder and the investor reduces the net setup cost. So obviously, if you believe that it is going to be there, this is a strategy by which you can kind of reduce your risk. You can pay less amount and you can still cover yourself against the position. So that is where the advantage of this kind of comes in, and that is where the advantage of this lies. Okay. Now there are the other strategies of using the puts. I just want you to look for tomorrow's session. I'll start from here. So I would want, so I've done this. I just want you to look at these ones at your end, and then we can then and see if you can understand this. The bull spread using puts, the bear spread. Don't bother about the butterfly. I'll talk about the butterfly. So there are these two products that I want you to kind of look at: the bull spread using puts and the bear spread using calls. Same logic that I have used. I want you to kind of go through this to see if you can understand and see what is going on, so that we can kind of move from there. And then we'll talk about the butterfly, straddle triangle, and then move on to the pricing arguments in the whole thing. So that is, I would want for tomorrow, please just look at these two. They're like 4 or 5 slides only. The rest of the slides, I will obviously go back and do them in detail. But for the 3 or 4 slides, I would request you all to please go through that to see if you can understand what is going on, if that makes sense, and you can explain that to me in terms of what I have on the slide. So that I would strongly request you to kind of please do that tonight or tomorrow before the class. I know you guys are working. I know it's quite late in the night today, but it's just like 4 or 5 slides. So my humble request to you is to please go through this and then come back to me tomorrow and tell me what did you get out of it. So please don't ignore it. Please do try it. Just 5 slides. It won't take you more than 5 minutes during the day at some point. So please do spend the 5 minutes to kind of do that. Okay. Okay. So let me stop with that. Any questions today? Any questions for now? Okay. So, guys, thank you. Please, I mean, once again, I'm requesting you to please look at those 3 or 4 slides, and we will start from there tomorrow and take it forward. Okay. Thank you. Good night. Update today's slide. You don't have today's slide, the slides? I thought I'd updated all the slides. I'll just check. Just give me a second. Oh, files. Oh, sorry, it is not there. I'll just update it right now. I'll just update it right away. I'm sorry, it was not there, but I'll just update it right away. I mean, there's one slide I missed, but I'll kind of do that immediately. Done. Sorry, my mistake. I have done that. My mistake that I had not. I have. Okay. Thank you. Thank you, guys. Bye. Good night.